When Warren Buffett speaks, the investing world listens, and for decades, his advice has stayed remarkably simple and remarkably effective. In this video, we're distilling Buffett's best investing principles straight from years of Berkshire Hathaway meetings. Timeless rules you can apply whether you're managing hundreds of dollars or millions. Before we begin, hit like, subscribe, and tap the bell. Because when it comes to building wealth, the smartest move is learning from the masters. From patience to discipline to knowing when not to invest, let's unpack the strategies that made Buffett one of the richest and most respected investors in history. 10. The foundation. Invest in what you understand. Buffett's circle of competence principle is foundational. He only invests in businesses he can fully comprehend. This means understanding how the company makes money, its competitive advantages, and industry dynamics. When Buffett avoided tech stocks during the dot-com boom, many criticized him. But he stuck to his principle because he didn't understand the business models. This discipline saved Berkshire from massive losses when the bubble burst. Before investing, ask yourself, can I explain this business to a 10-year-old? If not, move on. This simple test has prevented countless investors from losing money in businesses they never truly understood. 9. Quality over bargains. Buy wonderful companies at fair prices. Early in his career, Buffett bought cheap stocks following Benjamin Graham's value investing approach. However, he evolved this strategy after meeting Charlie Munger. Instead of buying mediocre companies at great prices, he learned to buy exceptional companies at reasonable prices. Wonderful companies have strong moats, competitive advantages that protect them from rivals. These might include brand loyalty, network effects, switching costs, or regulatory advantages. Companies like Coca-Cola, Apple, and See's Candies exemplify this principle. They can raise prices, maintain market share, and generate consistent cash flows over decades. 8. The power of long-term thinking over short-term noise. Buffett's favorite holding period is forever. He views stocks as pieces of businesses, not trading instruments. This long-term perspective allows him to ignore market volatility and focus on underlying business fundamentals. When you buy with a long-term mindset, temporary market fluctuations become irrelevant. Short-term thinking leads to emotional decisions, buying high during euphoria and selling low during panic. Buffett famously said his favorite holding period is forever because truly great businesses compound wealth over decades through reinvestment and growth. 7. Master your emotions. Be fearful when others are greedy. This contrarian principle is perhaps Buffett's most famous advice. When markets are euphoric and everyone is buying, prices become inflated and opportunities scarce. Conversely, when fear dominates and others are selling, prices drop below intrinsic value, creating opportunities. During the 2008 financial crisis, while others panicked, Buffett invested billions in companies like Goldman Sachs and General Electric. His willingness to act when others were paralyzed by fear generated enormous returns. This requires emotional discipline and independent thinking, two qualities that separate successful investors from the crowd. 6. Understanding the critical difference between price vs. value. Price is what you pay. Value is what you get. This distinction is crucial for successful investing. A stock's price fluctuates based on market sentiment, but its intrinsic value depends on the underlying business fundamentals. Smart investors buy when price is below value and avoid purchases when price exceeds value. Buffett uses various methods to estimate intrinsic value, including discounted cash flow analysis and comparing businesses to their peers. The key is developing the ability to estimate what a business is worth independent of its current stock price. This skill separates successful long-term investors from speculators. 5. The diversification debate. Concentration vs. spreading risk. While conventional wisdom promotes diversification, Buffett believes in concentrated investing for knowledgeable investors. He argues that diversification makes little sense for those who know what they're doing. However, this doesn't mean reckless concentration. Buffett typically holds his top 5 positions as 60 to 70% of his portfolio, but these are businesses he understands exceptionally well. For most investors, especially beginners, diversification through index funds makes more sense. The key is honest self-assessment about your knowledge and capabilities. 4. Harnessing the eighth wonder. Compound interest is your friend. Buffett calls compound interest the eighth wonder of the world. Starting early and staying patient allows small amounts to grow exponentially over time. He often uses the example of buying Coca-Cola stock decades ago. The dividends alone now exceed his original investment. Time is the investor's greatest asset because compound growth accelerates over longer periods. Even modest annual returns become substantial wealth when compounded over decades. This is why Buffett emphasizes starting young and thinking long-term. The mathematics of compounding favor those who start early and stay consistent. 3. Forget predictions. Don't try to time the market. Attempting to predict market movements is futile, according to Buffett. Instead of timing the market, he focuses on timing the market. Markets are unpredictable in the short term, but tend to rise over long periods as economies grow and businesses create value. Rather than trying to buy at the absolute bottom or sell at the peak, successful investors make regular investments regardless of market conditions. Dollar-cost averaging into quality investments over time typically produces better results than attempting to time entries and exits. 2. The mindset shift. Investing vs. speculating. Buffett distinguishes between investing and speculating. Investing involves buying pieces of businesses with the expectation they'll grow and generate cash over time. Speculating focuses on price movements and market psychology rather than business fundamentals. True investors study financial statements, understand competitive dynamics, and evaluate management quality. They're prepared to hold through market volatility because they own pieces of profitable enterprises. Speculators, on the other hand, chase momentum and rely on greater fool theory, hoping someone will pay more for their shares regardless of underlying value. 1. The ultimate truth. Patience and discipline trump everything. These principles have guided Buffett through various market cycles and economic conditions. They're not get-rich-quick schemes, but proven strategies for building long-term wealth. The beauty lies in their simplicity. They don't require complex formulas or insider information, just discipline and patience. Remember, investing is not about beating others. It's about achieving your financial goals. The most successful investors aren't the smartest or most connected. They're the most disciplined. They stick to their principles through bull and bear markets, resist emotional decisions, and let time work in their favor. Buffett's success isn't built on secrets. It's built on discipline, patience, and never forgetting the basics. Which of his principles do you follow or need to start following? Drop it in the comments so we can all learn from each other. If this gave you a fresh perspective on investing, like, subscribe, and share it with someone who's trying to shortcut their way to wealth. Until next time, stay patient, stay informed, and invest like you mean it.